We want to thank everybody for joining us today. We're very excited to have Abel Fregoso from Wells Fargo on the webinar with us today. Abel's going to give us a lot of really good information. Worked with Abel for some time now, extremely knowledgeable in the short sale area, and he's going to provide some really, really good information when it comes to short sales, especially in Wells Fargo's position. So what we're going to do is we're going to turn it right over to Abel and let him give you the information directly because he's got a lot of good stuff to share with you today.
Good afternoon, good morning, wherever you may be. I want to thank Brandon and Long & Foster team for allowing me to spend some time with you guys talking about short sales, specifically with Wells Fargo. This webinar comes at an opportune time because we're really looking at 2013 as a big short sale year. And we're really focused as a servicer to get as many short sales through this year as we can. And we're going to talk about some of the things that we've done to streamline the process. But I can tell you right off the bat that if you're not doing short sales, then you're missing the boat. We've gone through a cycle, or at least in the middle of a cycle, that is beyond what you could imagine from a servicing standpoint. I always like to use the movie 300, where there was 300 soldiers against 10,000 army invading, and we were the servicers, we're those 300, just absolutely overwhelmed. And let me show you exactly what I mean. Can you go to the next slide, please? So in the last cycle that we experienced a downturn in the market, the 30-day delinquency topped out at 3.3%, and that was in 1991. As you can see on this slide, this cycle around the second quarter of 2010, that same delinquency number has tapped out or capped out at 11.3. Now, it took 13 years from the last cycle to get from 3.3 down to a normal number, which is around 1.5. And I can tell you, growing up in the mortgage industry, you have 1% delinquency, you're okay. 2% delinquency, you're in trouble. 3% delinquency, you're out of business. And that's why you've seen so much consolidation of servicers and lenders in that cycle that we had, and more importantly in this cycle. I mean, Countrywide, WAMU, Wachovia, all those companies are gone, and that's the reason why, because of the tremendous amount of delinquency that has occurred. And you will notice at the bottom of the page that in the third quarter of this year, that number was still at 10.77. So, you know, the potential for great amount of delinquency that needs to get resolved through either retention, which is what we try to do with modifications, forbearance, and refis. But when we determine that the customer can no longer afford to keep that home or afford to make the payments, then we take them to the next level of default liquidation, which is actually liquidation. And you liquidate the asset either through a short sale, deed in lieu, or eventually foreclosure. And I can tell you that Wells Fargo's position is that we want to do everything we can to keep that customer in that home. But if all efforts have exhausted, then we go ahead and talk to them about the liquidation process. Let's go to the next slide. So knowing that we have this tremendous amount of customers out there that are still struggling, we have to enlist you, the realtor, as our strategic partner to help us in getting these customers with the answers, with the options that they want in order to get this problem resolved. I mean, if you look at those numbers that I showed you, we have what we typically call the pig and the python. In that pig and the python, we continue to work through a lot of the modifications. We want those customers to stay in the home, but again, if that customer cannot afford to make the payments anymore, then we have to have experienced real estate brokers and their agents that are familiar with the management of distressed real estate. To us, that's the key and commitment to quality service, and that's why we reach out to you guys, especially Long & Foster, which is a company that has a lot of superstars that understand the distressed market. So we want to be partners with you. So let's go to the next slide. So let's talk about what is a short sale and why a short sale makes more sense. So as soon as a customer has a hardship, we assign what we call a home preservation specialist. This home preservation specialist will work with the customer to determine what options are available in the waterfall of options for them, whether it be a refi, whether it be a modification, a forbearance. It's a workout option that allows the homeowner to sell that property once it moves into the short sale or the liquidation piece. Now, what makes a short sale a lot more difficult than a traditional sale is that a short sale is a settlement of debt. That means that you have to align all the decision makers in order to get a short sale approved. But you can see with this slide here how the progression occurs. You have a hardship. We begin working with the customer on a retention piece. When that retention piece fails, then we start talking to them about the short sale and possibly a deed in lieu if a offer is not available for the particular property. So let's take a look. Let's go to the next slide. And again, the last thing we want is a foreclosure. That's why in 2013 you're really going to see a major focus as we have in 2012. But I think that with all the measures in place that we've been putting, and a lot of the investors already starting to give us delegated underwriting authority, you will see that process streamlined and it'll move much faster. So let's talk about what a hardship is. On the board or on the slide, you will see your historically accepted hardships. You got a death, primary or secondary wage earner, an illness, long-term disability, forced job transfer, unforeseen increased living expenses. I want to touch on that one a little bit, okay? It's the key word there is unforeseen, okay? If the customer goes out and buys 2 Mercedes-Benz, a boat, and a motorhome and can no longer afford to make their mortgage payment, that is not unforeseen living expenses. An unforeseen increase in living expenses could be if they took out a adjustable rate mortgage and now the payment is resetting to 2 or 3 times the amount that they're used to. Now they can no longer afford that payment, and so that becomes an unforeseen increase in living expenses. Other examples, loss of employment, significant reduction in income, a divorce, just talked about the mortgage payment increase, some kind of disaster, or if their business and it fails. The one thing you won't see up here is a mortgage that is underwater. Just because a customer owes more than the value of their home does not make it a hardship. A hardship is one that the customer can no longer afford to make the mortgage payments. If someone decides that they're upside down and they're going to stop making payments, that becomes a strategic defaulter. In that particular instance, we're going to be much harder on the collection of the deficiency if there is a deficiency come a strategic default. So I just want to make sure everybody understands what drives the short sale is the hardship. So let's go on to the next slide. So this is your typical participants in a short sale. You have your homeowner, realtor, You've got the buyer, realtor, the buyer, and then you've got your servicer. And you can look at this as a traditional transaction where the buyer and the seller agree to a price, they order a payoff from the servicer, and the transaction closes 30 to 45 days later. So in a short sale, let's go to the next slide. In a short sale, you can potentially have many more decision makers that have to align as opposed to just ordering a payoff from the servicer. If you have a junior lien holder, they have to agree. If there's private mortgage insurance, they have to agree. And then if you have the investor, then they have to agree to the settlement. And one of the things that I always tell the agents about a short sale is that we would love for you to take on every single short sale that comes your way, but the reality is that you want to get paid, and the way you get paid is if that transaction closes. And so I always emphasize that you have to have some degree of filtration in your process in order to determine, do I want to take this short sale on? And let me give you some examples that can kind of clarify what I'm talking about. So in Olympic diving, you have your degree of difficulty. The higher the degree of difficulty, the higher your score can be. I want you to look at short sales as the opposite. The higher the degree of difficulty in that short sale, the less probability you will have of closing that transaction. So I like to give the audience a scale of 1 to 5 that can give you an idea of the short sales that you want to take on, or as you become more experienced, you can take on the more difficult ones because you have the experience to do that. So my first degree of difficulty, number 1, is a portfolio loan. That's a loan that is owned by the bank. They make the decisions. There's no juniors. There's no MI. That's a number 1. A number 2 is an investor loan. Okay, you got to go to the investor. They've got to approve it. A number 3 would be an investor loan with the junior lien holder. A number 4 degree of difficulty would be an investor loan with a junior lien with MI. Okay, and then your category 5, which is the ones that a lot of times people take on and have no clue why it's so difficult, is when you have a service, you have an investor, you have multiple juniors, you have MI, you have HOA liens, you may even have IRS liens. So, that particular transaction is going to be extremely difficult to complete. And so when you're out there working with these distressed homeowners, you really have to sit down with them, roll up your sleeves, and find out exactly what that transaction is all about. Because it's no longer about writing up a listing agreement and putting it on the market and see what happens. I mean, you have to know everything about that transaction, who the lien holders are, if there's MI, if there's a juniors, what kind of settlement they're going to accept. So it becomes a very, very tedious process that you have to commit to in order to take it on. And a lot of times what ends up happening is you have to get the homeowner or the distressed homeowner to really commit to being engaged with the transaction, because it starts with you, the listing agent, and the homeowner being engaged, being able to disclose everything to you so you know exactly what type of transaction you're dealing with. Is it a category 1, 2, 3, 4, or a 5? And if it's a 5, you better be prepared to really, work hard, because it's going to take time to get that one done. So let's go on to the next slide. So we truly believe that once the retention options have been exhausted, that the short sale is the best alternative to foreclosure. It is something that is going to benefit not only the customer, but the buyer, the junior, and even our community. So let's talk a little bit about the benefits to the customer, because that's what you as the listing agent have to sit down and try to convince them why it is better to short sale than to allow it to go into foreclosure. I mean, to begin with, it is a planned and graceful exit from this distress situation that they're in. The other thing is, in many cases, we're going to offer incentives for relocation and also allow to pay closing costs on some transactions. The other thing that has become a big bone of contention has been this IRS Debt Relief Act that expires at the end of this year. We at Wells Fargo are very confident that that particular debt relief code is going to be extended through the end of either 2014 or maybe even 2015. That kind of gives you an idea of the amount of work that is still ahead of us in this arena. You know, one of the things that our investors have really moved to is really starting to waive a lot of the deficiencies that are coming about. In fact, in California, they have state laws that do not allow for investors and servicers to collect deficiencies, but you know, the investors are getting very wise to why it makes sense not to go after a customer and deficiency. And a lot of times, what you want to make sure you do as a authorized third party for that borrower is, when you're getting your demand letters, which technically are approval letters, make sure that the verbiage in the letter states that there will be no deficiency recovery. And you have to have it in the letter, or else it opens it up for future possibilities of going after the customer. If it's something that you get a letter and it has the verbiage that they have the right to collect, you've got to go back to the negotiator and say, look, this is a deal killer. My seller will not accept this demand letter. I need you to have the verbiage that's going to waive it. And they will go back to the investor and they'll say, this is a deal killer. We can get it, we can still get it done. We just need the verbiage, and they'll change it. I've seen it many times where they have changed it when a transaction was outside of California. So the benefits to the buyer is that they're getting a much better conditioned property than if they were to buy a foreclosure. One of the things that we started to see quite a bit in the REO world was properties coming back damaged. I mean, severely damaged. And you know, when you're dealing with human emotion, you're dealing with all sorts of different types of emotion. And when people really get mad, they take it out on the property. And so we feel that by allowing the seller to stay in the property until there's a transfer, that you know, the buyer's going to get a much better conditioned property. And it also helps our communities. We want to be part of the stabilization of our communities, and in part the short sale does that as well. The benefits to the junior lien holders is that, you know, little by little, as policies change, they get better. I'll give you an example. If you're doing a half a loan, the maximum that a junior could get would be $6,000. Now they're up to $8,500. On our proprietary programs, we can go as high as 10%. So little by little, we're getting better at making sure that the junior liens are aligned and they can go ahead and complete the transaction. A little bit about the industry lien match program. When the AG settlement came to be, there was 5 major servicers that participate: Bank of America, Wells Fargo, Chase, Citi, and Ally. And I'm sorry, yes, Chase, Citi, and Ally, which used to be GMAC. So this industry lien match program, if the first mortgage is a portfolio loan that any of these 5 servicers own, and the second is also a portfolio lien that any of these 5 major servicers own, then the program aligns itself to where they have to accept 10% or $8,500 max. Now, once we process the short sale and we determine, okay, our first is a portfolio loan, and let's say the Bank of America second is also a portfolio loan, we communicate with Bank of America and we tell them this is an industry lien match loan, so we're going to offer you 10% or $8,500. Again, it's another way that we are instilling policies that are going to help streamline the process, because for those of you who have done short sales for a while, you realize that negotiating with a junior lien can be quite tedious, could be quite frustrating. So little by little, we are getting these programs to be a lot more transparent and making the experience be much better, both for the realtor as well as the customer. And finally, as I talked earlier about our communities, we want to make sure that we don't see what we saw in 2009 in some of the areas. You know, I'm in California, so I can tell you that in Southern California we had some areas that we refer to as the Inland Empire, and we had neighborhoods where you would drive down a street and there would be 12, 13 properties on that street, and 8 or 9 of them would have green, brown grass, and you knew that those were vacant properties that were foreclosed on, and you just felt like it was, you know, a ghost town. So that's the type of things we want to eliminate by, you know, having a successful short sale program. Okay, let's go ahead and move on to the next slide. So we're going to talk a little bit about navigating through the short sale process. So my first questions to you all is, does a homeowner need an offer in order to initiate a Wells Fargo short sale? A or B? Let's go to the next slide. And I know all of you said B, and that is correct. You do not need an offer in order to initiate a short sale with Wells Fargo. And I would encourage you that as soon as you have a listing agreement, your HUD, your estimated HUD, and your authorization to accept the authorization to be the third party, you should immediately upload and initiate that through Equator, because what will happen is there are certain loans within Wells Fargo that cannot be processed through Equator. And I'll give you an example. All of our HAFA loans, okay, and everything that comes through initially we look at to see if it is eligible for HAFA, okay. You initiate the short sale through Equator. Then we review it for HAFA eligibility. If it is deemed to be eligible, we will send you a task to remove the file from Equator and submit it through our traditional methods, which is through the fax machine. So you would go ahead and do that. Now, there's other loans that we also service, for example, the Wachovia loans. Those loans are not serviced through Equator, so you would have to go to the traditional way. But by and large, I would say 80 to 82% of the loans that we service will be processed through Equator. So again, as soon as you have that listing agreement, initiate the short sale so that we can start letting you know the type of documentation we're going to need, and you know what kind of value we come up with, because we'll order the value immediately. As soon as you initiate it, we open a template and we go ahead and order an appraisal on it. Now, the appraisal can be anywhere from a drive-by, full interior inspection, a BPO, a desk review. It all depends on that investor that we're servicing for, what they're comfortable with. So, but the good news is that as soon as we have that valuation, we begin dialogue and discussions with you about where you're thinking of pricing the property and where we're thinking that you should price it in order to net what we need to in this transaction. Because in a short sale, it's not your listing price that drives the transaction. It's the minimum net that the investor or lender is going to get after everything is said and done, closing costs, commissions, any kind of concessions. So that's what we look at as the minimum net, and then we help you to try to price the property with agreement that you're the expert in the market and that you want to tell us exactly what you think that property is worth. All right, let's go on to the next slide. So there's three ways you can initiate again the short sale. I encourage you to go number one as the first method is doing it through the platform of Equator, okay? Because then from there we can tell you, okay, this particular one you'll have to take it through option 2, where there you have the loss mitigation fax number and their actual phone number you can call. The third way would be through our local market experts. We call them field short sale managers. We had one in Maryland for a while back. We are in the plans of hiring a new one because we definitely want to grow. We understand we're seeing more and more distressed homeowners in the Maryland, Virginia area, so we want to make sure that we put boots on the ground there. I would anticipate that we should have that position filled come the first quarter of next year, and I'll definitely stay in contact with Brandon to get you that information. And the way these field people help you is, you know, they're going to be face-to-face support for you. They're going to be working the portfolio loans, and they also will act as liaisons for the servicing portfolio. So there's a lot of benefit that you will get with having this type of individual in your market helping you through some of these transactions that require a little bit more TLC or whatever we may need, but we definitely are going to put another individual in your market. All right, let's go to the next slide. So again, the options that we offer our customers is the very first one is going to be the Treasury HAFA. Now the good news now is that there's only one HAFA program. In 2012, there's truly were two separate HAFA programs. There was the Treasury program, and then there was the GSEs. Fannie and Freddie had their own version of HAFA. Well, they have now streamlined their process, so their HAFA program has gone away, and we'll talk a little bit about what that means to you from a real estate professional as to how Fannie and Freddie have streamlined their process. But again, now we only have one HAFA program that we offer. Every single short sale that is initiated is going to be reviewed, and if it does qualify, then the customer will get $3,000. If there's a junior, they'll get 85 up to 10%. The other thing that I really like about HAFA is that there is absolutely no deficiency that the servicer or lender can come after if it closes through the HAFA program. And the second benefit is that the full 6% commission is paid on all transactions. Keep in mind that if the customer doesn't qualify for HAFA, then we have our proprietary short sales that we can still do. But in the proprietary, there could be some investors that may want to reduce commission. And so when that particular situation occurs and you know it's going through a proprietary short sale, ask the question up front when you first start engaging with the processor or the negotiator if this particular investor is reducing commissions. So it's an important question to ask. We'll also offer relocation assistance on the proprietary short sales. The interesting thing about it is that the longer the customer has gone delinquent, the less money they're going to get. So the idea is to try to get these customers that are barely starting to go delinquent and that really want to stay in the house but they know they can't. Well, let's get this done and we'll get you some financial assistance so that you can relocate. And the final thing is we will go up to 10% on some of these junior payouts. So we do take them on a case by case. All right, so let's move on. So this is a guide to collecting the initial application for a short sale. And a lot of times you will see that we may not need this documentation. But you know what? If you're going to do this right, get this stuff up front. If we don't need it, you don't need to send it in. But what happens if you don't get it and then we need it? Now you got to go back and bother your seller. So, you know, get your hardship letter. Make sure that it's, you know, signed and dated within 60 days. Get your financial worksheet. Get proof of income and your authorized third-party letter. Okay, that's what we're going to need from the homeowner. From you, we're going to need your fully executed listing agreement and your estimated HUD. And in that estimated HUD, you want to go ahead and put in there that $3,000 for relocation assistance for the customer, and you know, whether it be 10% to the junior. Make sure you're including all that in your HUD, so that way when we analyze the HUD, we can see that you've already accounted for some of those things to make sure. Now, again, if it's a portfolio loan, we may not need any documentation. So this is just a good rule of thumb so that you get this stuff from the homeowner and you get this stuff from your side, and let's initiate the short sale. All right, let's go to the next slide. So this particular slide kind of gives you the Wells Fargo short sale path. So there's 6 steps to this, okay? And you know, you want to get the homeowner to agree, yeah, we want to do the short sale. You go ahead and you initiate it through Equator, and if it is deemed to be HAFA, then we pull it out. If it isn't, then we go proprietary, we set it up. We get the information that we need, and we order the appraisal. And then we start collecting the documents that we may or may not need, depending on the investor, depending on the short sale. But the 2 buckets that you'll run in most trouble is the processing and the negotiating. And here's the reason why. In the processing, you have to provide us all the documentation that we're asking for. It has to be properly executed, and it can't be dated. If you provide that in a timely manner, you should be able to go from the processing over to the negotiator once you have an offer. But if you're not providing us with complete packages, poorly executed documents, or even dated documents, that's where you're going to have most of your problems in the processing bucket, okay? So make sure you're submitting everything complete. The second bucket, the negotiator bucket, is where you'll potentially have some issues, and that's because of the valuation. And that's why I encourage you, when you first initiate the short sale, to get into the discussion with the processor, with the negotiator, about where you want to price that property. Because what I've seen is that we may have a VPO or an appraisal of $250, and then you guys may have one at $225. You decide to price it at $215, and someone, potential buyer, comes in and makes an offer of $185, and then now we have that that disparity between those 2 numbers. So what I encourage agents to do is, if you know it's worth two and a quarter, price it at 2 1/4. Don't price it lower to generate multiple offers. Price it at where it's at, because you know these buyers are going to come in below that number. And the further we are apart, the more difficult it becomes to get the transaction done. So I highly encourage you to price those properties at what you think market value is. And then the last two buckets, the closer and the settlement, they're pretty much there to verify when it's going to close and all the funds come in. So you're pretty much, out of the woods, so to speak, when you get through the negotiating process and getting into the closer. So that kind of gives you an idea of where how the short sales are processed. All right, let's go to the next one. So what is the difference between a lender and a servicer? And a lot of people really don't grasp this concept. They think that we use Wells Fargo. When Wells Fargo denies a short sale, Wells Fargo is the bad guy. Well, let me give you an idea of what the difference is. Let's go to the next slide. So we service over 11 million mortgages nationwide, and 82% of those loans that we service are for outside investors. And of those 82%, you will see that 69% of that is Fannie, Freddie, FHA, and VA. And even though the VA portfolio is pretty small, our largest investor is Freddie Mac. And then, believe it or not, FHA, and then Fannie Mae. And so those particular investors are the ones that are dictating the approvals and denials of these particular short sales. Now, what we encourage the real estate agents to do is to determine, again, up front, who has that mortgage. Is it a GSE? Is it FHA? Because the path to those particular investors is going to be a bit different. And we'll get into some of the streamline issues that have occurred with Fannie and Freddie. But you'll notice that 18% of what we have is balance sheet loans. These are the loans that we own. And then this 13% is investors such as American Servicing Company. A lot of you probably heard ASC loans. Well, these were loans that were not originated by Wells Fargo or underwritten. We just serviced them. So let's move on. This gives you a good idea of what the difference between a servicer and a lender is. So the Federal Housing Finance Agency announced a new standard short sale guidelines for Fannie and Freddie, and this is the reason why their HAFA program has gone away, because they want to streamline. So here's what they have. If the customer is 90 days delinquent and has a credit score below 620, we know they're in a hardship. That's clear. And so they are asking us to completely eliminate the documentation such as income documentation, hardship letter, financials. We don't need any of that anymore if that customer is 90 days delinquent and has a 620 FICO. Okay? Now, they're giving us complete delegation on files where I call them the 4 Ds exist, okay? Death, divorce, disability, or distance over 50 miles for a job, even if the customer is current. This is huge because before, Freddie required the customer to have been 60 days delinquent, and Fannie would actually entertain the initiation of a short sale as long as the customer passed the imminent default issue. Now we don't have that anymore. Now if it falls under death, divorce, disability, distance of 50 miles or over, they can initiate a short sale with the GSE. So again, that's huge. Now here is where we were talking about the deficiency. if the borrower shows capacity, and they're going to ask for financial contribution in order to waive the deficiency. Now, if the customer is at a point where they absolutely have no money, then those are those customers that are going to have their deficiency waived, and there won't be an issue with that as long as the verbiage is in the approval letter. And that's why you have to be on top of that. But if your customer or the seller shows some degree of capacity, there may be a note or cash being asked for. So just keep that in mind. And that's with the GSEs now. Now the GSEs are going to allow us to go up to $6,000 on junior liens, and military personnel that have to be relocated are automatically eligible for a short sale, even if they're current. All right, so let's go to the next one. So these guidelines came into effect on November 1st, and here is one thing that, again, going back to the streamlined process of getting these deals done in a timely manner, we have to have a decision made on a short sale within 30 days of having a complete package with an offer on there. So that's good news. And we have up to 60 days to communicate that information. And again, it starts with a complete package before these times begin ticking. Now, here's something that really is going to give you some ammunition when it comes to talking to the borrower about short selling your property. The GSEs are going to allow a former borrower that goes through the short sale process the ability to buy again after 2 years of that short sale. And, you know, one of the things that we always stress to these homeowners that are on the fence on whether they should short sale or just allow it to go into foreclosure is that if you do go through a foreclosure, you're looking at 7 years before they can even look at you for another mortgage. Now, with these new guidelines, this gives the homeowner the opportunity that in 2 years they could be back in the saddle and have and buy a new home. So that's huge. Good move on their part. So let's go ahead and go to the next slide. So just a couple of things to remind you on time frames. These approval letters, and we call them demand letters, are good for 60 days. Okay. You know, we've had issues with financing where it may take longer. Let me back up. I'm sorry. The approval letters are usually rendered within 60 days, and they're good for 30 to 45 days. The 30-day I put in there because that's for California. Everywhere else is 45 days. That's why we have to make sure that once you get your approval, you get that buyer and buyer's financing, or if it's cash, you get them to really engage, be committed, because, you know, we don't want that letter expiring. But if it does expire, we do have the ability to extend it. If there is a sale date, then it becomes more difficult. The short sale approval does not guarantee postponement of a foreclosure, and that is true. That's what we call dual tracking, and, you know, California just passed a law where beginning January 1st, they're not going to be able to dual track, but everywhere else in the country we still have the ability to start the notice of default while we're working through whether it be a modification or a short sale. So you still have to follow that property timeline to make sure that there is no foreclosure date coming up on you. Okay, and we can close, you know, the short sale up to 5 days prior to the foreclosure date. And we don't recommend you cut it that close, but that just gives you an idea. Let's go to the next slide. So in September, we launched a online resource center for the agents. You can see on the slide www.wellsfargo.com/short sale agent. We're continuously making improvements to it. We encourage feedback from agents that navigate through it. Tell us what you would like to see. Tell us if there's documents that are missing that you would like for us to add. So there's a lot of feedback that we're expecting from agents that can help us make this a better resource for your ability to process a short sale at Wells Fargo. It's something that was a long time coming, and we were able to get it done. All right, last slide, please. So I'm going to leave you with a number, and this number is a servicing default liquidations escalation number. It's 1-877-841-5301, and they are open from 7 a.m. to 10 p.m. Central Standard Time, Monday through Friday. So if your short sale stalls, this is the number you want to call, okay? And hopefully they're going to be able to give you the answers that you need. But at times, you may find that you may have to escalate through another avenue, and we'll talk more about that in the future on how we can streamline escalations. So that's my presentation. That's what we have. Brandon, I'll turn it back over to you.
Abel, thank you so much for that. That was some really great information, and that is as up to date as it gets. As Abel was mentioning, some of these guidelines are just come into play November 1st, and a lot of us in the real estate community are really unaware of all the things that have changed. So again, Abel, I really want to thank you for your time. That was an excellent presentation, and this is some great information that our agents can use in the field.
Excellent. Excellent.
Thank you, guys, and stay tuned. We'll keep you informed and keep you in the loop at all short sale changes, especially when it comes to Wells Fargo.